All right, so we're ready to move from the market risk premium to beta. But before we do that, I want to just show you there's an article out there on Blackboard. It's the Barclays market risk premium article. It's very dated. It's 2002. The reason I'm showing you this is a famous article that essentially got everybody moving from the old historical approach to coming up with the equity risk premium to what we call the implied approach. Barclays does update this every year. I just don't have access to the numbers before. I've met this guy, Barton Waring. If you're in my risk management class, we talked a lot about pension plans, and he was their big pension plan guy. I strongly disagree with him on his approach, but it was interesting talking to him. So they go through this, and they do exactly what we've been talking about in class. You'll see a formula down here where he's saying the expected return on stocks equals, this first part is the dividend yield. He has a couple things in there. The dividend over price is the dividend yield. That's that 2.25% that we use. Then he did the minus. They did minus a change in number of shares of stock. Essentially, that's an adjustment for stock buybacks. We're not making that adjustment in our case. If you take my security analysis class, we do make that adjustment. That adds maybe 1% to the yield for stocks. But we're ignoring that here because companies are buying a lot of their stock back now. The next two pieces, inflation and real growth, essentially they're combining those two together into one. We're combining it in one number, and that's expected growth of the earning of the stock. So we're saying growth in stocks equals economic growth. And we're breaking it up between productivity and labor growth and inflation. But they're showing expected earnings on stocks is the inflation rate plus the real growth in earnings. And then the last thing they have is a repricing, which is an adjustment for whether or not the stock market's overvalued or undervalued. I actually disagree with them on this, that they shouldn't make this adjustment. If you take my security analysis class, I go through why I disagree with that. But what I really love about this paper, first of all, they show you the historical return on stocks, which at the time this paper was written was about 10%. Obviously, it probably hasn't been that high because of the 2008 crisis. They did write this paper right after the dot-com crisis in 2000, but it does not include the 2008 crisis or the strong stock market growth after the 2008 crisis. So it would probably be a little bit lower today, but they show you that the income return historically at 4.4% is much, much, much higher than what the current yield is. So we're using 225. Maybe you would add 1% to get up to 325 if you adjust it for stock buybacks. And then the next two is earnings growth. Remember, we use 5%, 2.5% productivity plus 0.5% for labor growth plus 2% inflation. So we got 5. They're using 4.8, which is really, really close. And then they're having 1.5 for repricing. These are historical actual numbers. But what we're doing is we're projecting what we think is going to go forward. What they do with the rest of this article, which is really, really good, is they walk through each one of those things. Income return, stock buybacks, inflations. They have the same thing we're doing where they're tying things back to economic growth. So there's GDP growth. So it's an interesting article. It is dated, and the numbers are certainly very dated, but the concepts are not dated at all. It still works very, very well today. And so they have charts that summarize what they're doing, and here's what they're predicting. And it's interesting, their dividend yield, their income return, 225 is the exact number we're using. It may just probably be coincidence because our dividend yield was 225, but they're adding 0.75 for stock buyback, so they're actually using 1.5% dividend yield plus 0.75. So it's not exactly our number, it just happens to coincidentally come out the same. They're using 6% earnings growth, we use 5%. And then they have something I strongly disagree with. So if you take my security analysis class, I'll talk why I don't think they should make that adjustment. But anyway, it's an interesting paper. So I do encourage you, if you're a finance major, you might read this over the summer. Get you ready, especially if you're going to take my security analysis class, which is a really, really tough class. But if you can get some ahead reading, it can definitely help you with that. So, all right, so let's move to beta. We've already done beta. Beta is revenue sensitivity, operating leverage, financial leverage, and historical. So I'm going to hit pause just a second so I can load a couple of files that we'll need for this. All right, so I'm doing Walmart, so I'm going to put this into Excel. You have to do this in Word, in a Word document, but you can definitely use Excel to build up just like I'm doing here. So here, let me do the beta for Walmart. So step 1 is revenue sensitivity. So I'm going to argue, and let's put this in a different color here. It might need more room, but we'll see. So I'm going to say Walmart is definitely a defensive company with beta below 1. But they do sell higher cost items. They do have flat screen TVs and computers in addition to groceries. So I would not give them a beta as low as a grocery store. Like Kroger's, I might use 0.5 or 0.6. For Walmart, I'm probably going to get closer to 0.8. So I'm just going to say maybe the range here is 0.6 to 0.9, but we'll see. I'm going to show you how to do a data table later, but I think 0.6 to 0.9. I don't really think they're below 0.6 because 0.6 would be a grocery store, and Walmart is not 100% a grocery store. I know they're doing extremely well right now because of the coronavirus, and that certainly argues for a much lower beta. A company does extremely well during a financial crisis would imply even a negative beta, but this is an unusual circumstance, and I don't want to calculate a beta. It only works in this one particular scenario. So there's my step 1. There you just have to write, put it in words. So don't summarize as much as I'm doing here, but put it in words. And then step 2 and 3 is operating and financial. Well, let's do it in the exact opposite article. Let's do financial and operating leverage. So for this, if you go to Blackboard, you will find a file that is called Bloomberg Data to help determine beta. Right now I have cost code loaded, so I'm going to hit the equal sign, and you go to the paste values data. We did this in a previous class, and find the ticker for your company. So our ticker for our company is WMT for Walmart. You can't do Walmart for your company, but if I put this in here, I'm going to take this, I'm going to copy and paste it into my file. I'm going to put it over here on the side. I'm going to paste it as a bitmap. Well, he won't let me do that, so I'm going to paste it as values and number formats. So here's what I have for Walmart. I'm going to paste it one more time, and I'm going to paste formats. So there I've got it. So there's Walmart. Walmart is right in the middle there. So you'll actually put this table into your paper. So the first thing we're going to look at is debt to equity. Walmart's debt to equity is 52%. The median for the S&P 500 is 72%. So Walmart ranks in the 38%. They're below average. So for financial leverage, let me move this up. I put it in the wrong spot. But for financial leverage, I'm going to say it's below average, so supports the lower end of my range. So maybe we're going to do 0.6 to 0.8 instead of all the way up to the 0.9 because their financial leverage is lower. If we looked at Kroger's right now, Kroger's financial leverage is much higher than the average company. And so if you had for Kroger, you might for Kroger do something like 0.4 to 0.7. You might say, okay, I'm gonna do them from like 0.55 to 0.7. This is very subjective, but as long as you're consistent in your assumptions, I'll give you full credit for the discussion. And then operating leverage, I'm gonna say, well, this is a grocery. So inelastic demand and hourly workers. So low fixed cost. That's what I'm assuming. Let's look at the numbers. So we're going to look at the standard deviation of their margins. Their gross margin standard deviation is very low. It's 1.21% versus the S&P is 3.81%. Remember in your papers, this is not their gross margin. This is the standard deviation of their gross margin. How volatile is it? So their gross margins are very low, and their net margins even lower. Their net margins are 0.51% versus the typical S&P 500 company is 6.25. So they rank in the top 10% on gross margin and the top 1.3% on net margin. Very stable margins. So say, and the standard deviation of their margins support this. So again, the lower end of my range. So maybe now I'm getting to, let's say, maybe 0.6 to 0.7 might be what I'm thinking now. So what's step 4? Step 4 is history. We did that in the previous class, and you have a video on that. I'll do it again really fast, but I'm going to move fast because I don't want to have you be watching the exact same thing twice. So if I go into Yahoo Finance and I find Walmart, WMT. So here's I always do that. I always give me waste management. I don't know why the T doesn't come up. There's Walmart. I do historical data. When I do historical data, I want to go back as far in history as I can go, max. And notice that date, August 2472. So we want to do, you want to write this down. You want to write down 7/31/72. You want to go to the end of the month right before that. And we want historical prices, but we're going to do monthly. Some of my videos say to do weekly, but I do monthly now because that's what Yahoo Finance does. I'm going to download the data and load that. So now I've got Walmart's stock price all the way back to 1972. And remember, the only column we need is the adjusted close. So there's the adjusted close. I'm going to get rid of everything but the adjusted close. Just click on those columns and hit delete. And I'm going to put Walmart at the top of that so I know what it is. I'm going to change the formatting here to do commas. Again, we want the adjusted close, so we adjust for premiums. And I'm going to put the S&P 500 right here. I'm going to call it SPX. So let's go back and get the S&P 500. So if you go up to the top, there's the S&P 500. Again, warn you that if it's early in the morning, like 8 o'clock when you're doing this, it will not show the S&P 500. It will show the S&P 500 future. So to find the S&P 500, do Shift 6 and GSPC. That is the S&P 500. If the market is, if you don't have futures up here, you just have the S&P, you can just click on S&P. Again, do historical data. And when the historical data comes up, remember we want to go back to, I have to wait for all the titles to come over. We want to go back to 07/31/1972. And again, we want to do monthly. So you want to start the end of the month right before your company started. Hit apply, make sure you hit apply, and then download. And when you download it, you can load that file. Sometimes it takes a while. Anytime I'm recording for the class, everything is slower, unfortunately. I can download again. Sometimes it needs it twice. So download it. And so here's the S&P 500. I'm going to get rid of everything but adjusted close. Adjusted close doesn't matter here versus close, as they're saying, but I'll still do it. So I've got 8/1/72. I'm going to take this whole thing and do Control Shift down and right and hit Control C to copy and go over to my Walmart file And right next to the Walmart file, I'm going to type in that. I'm going to then click there and do Control down and make sure it's lined up. Now, we're in the month of April, so I'm going to take April out of that. So I end with March because April's not over yet. And so my dates are lined up, so I can take out the dates for S&P 500. And so now I'm going to do the holding period return for Walmart and the holding period return for SPX. So remember, you just take ending market value minus beginning market value divided by beginning market value. And it looks like it would be 0%, but these are actually two different numbers. They're going out several decimal places. I can copy that over to S&P, and when I have the two numbers there, I can just copy the whole thing down. And I've got the returns for Walmart and the returns for S&P, and now I'm going to do the rolling 5-year beta. So 5-year beta, I'm going to put a 1 there, and right below it I'll do that plus 1. I'm going to copy that down about 60 rows. I'm going to go down and find row 60 because row 60 would be 5 years times 12 months in a year, be 60. So I'll find that. I can delete all the others. And then I'm going to do my beta here. So equals slope. You do your company first, comma, then the market. So there's their beta. I remember doing this before in this class. I'm then going to do the median, the 10%, and the 90th percentile. So we'll copy this rolling beta all the way down. You can just copy that down, and now I'm going to do equal percentile. I'm going to do that entire range, comma. Well, let me lock it in. Comma, and go up and do the median, close parentheses. And then right below that, I'm just going to reference that. So plus that, and copy that over, and then I can copy this down. If your 50 percentile, 10%, 90 percentile are changing, they shouldn't change. If they're changing, it's because you didn't lock this in, and then you copied it down, or you have some other issue going on, but that's probably the most likely issue. And so when I take this, I'm just going to do a graph, insert, do a graph. So there's my rolling beta for Walmart. So Walmart rolling 5-year beta monthly data. I like to say whether it's monthly or weekly, and you'll see that. The only thing I have to do is go in and get the dates. So select on the dates. There's the dates. So now I've got my graph, and so I got to go in and edit the graph. You got to be careful. If your firm's beta goes negative, you may have to move your dates. So if you look at your dates, you may have to put your labels and make them low. And then for the number, I just want to do year, 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 and add that. So there I got my dates. I'm going to bold that. I'm going to bold my betas. And then the last thing I got to do is put the titles in there. So this first one is the 5-year rolling beta. This second one is the median. This next one, I can't remember which way I did it. The 10th percentile, and then this last one is the 90th percentile. Again, if you're using a Mac, it will look a little different. Macs, I don't like the way Macs do graphs. It just looks a little strange to me. So there's my graph. I'm going to now take this graph and copy it. You'll put it into your paper. I'm actually going to put it into my Excel file here. There's my rolling beta. I'm going to shrink it down right there. So if you look at this graph, it makes sense. We talked about this in a previous class, so this is repeat, but it makes sense when Walmart was a small company, their beta is really high. It's very, very normal for a small company to have a very high beta that declines over time. Recently, it's been very, very low. They did extremely well. Remember, they had a positive return in 2008, so very low beta with the 2008 crisis, and they've been doing extremely well now. So their beta has not been above 0.5 in quite some time. So that argues the lower end of that range. I think this is too low. I think it's just, there's some really just bizarre things that are going on. So what I'm going to say is, so we'll do history of beta. Put another color in here. So history of beta graph shows a median of about 0.95%, but includes the early history with a small company higher beta. And I'm not putting this in the way you do it in your paper. I'm doing this in bullets. You need to put it in more professional long sentences. I'll move this down here. Recent history suggests a very low beta, but I will stick to the bottom of my range. And so, given all the above, now this is really, really important, given all of the above, it's defensive with low operating and financial leverage and recent very low beta. I will use a 0.65 beta. So now I have my beta, 0.65. I hate it when Bill Gates says that. I don't want to change colors, so 0.65. Now I have all of my assumptions. And so now I have my KE. My KE, remember, KE equals the risk-free rate plus beta times the market risk premium. So here's my risk-free rate plus beta times the market risk premium. So there's my discount rate for Walmart. It's very low, which you're going to find out is going to be extremely, it's going to cause some issues for some of you. But there's my discount rate. So I'll stop it there. What we're going to do in the next session is get started on paper 4. But you've just completed paper 3. So you need to have a section in your paper about the risk-free rate. We talked about that in detail, about the market risk premium, about your beta. I mean, about your beta, you're going to have, I don't know why I changed colors between step 3 and step 4, but about your beta, let me change the color here. And then you'll just bring it all together, and it's real important at the very end of beta that you talk about everything. What most students do, that I'll take off a lot of points, is they do step 1 on beta, they do steps 2 and 3 on beta, they do step 4 on beta, and then your final answer only looks at step 4, only looks at the history. They don't talk about any other thing they did. So make sure your final paragraph on beta brings everything else back together. What some students do, which I really recommend, is they have a table that summarizes each one of these things and then has their final recommendation of 0.65. So you can see my starting range was 0.6 to 0.9. When I saw financial and operating leverage were much lower than average, I brought that down to a 0.6 to 0.7 range. And then when I looked at the history, I saw, yeah, definitely in that lower range. So I'm going to stick in that lower range at 0.65. I won't go all the way down to the 0.6, but go down to 0.65. And so that's my beta for Walmart. All right, we'll stop it there. This video is getting a little bit long. So my next video, I'll keep a little shorter because these are running on a little bit too long. But I don't want to keep switching videos in the middle of the paper. So you've now got 2 videos that get you, well, essentially 3 videos that get you through all of paper 3 with everything you need.